Let me know when we're go.
We're good.
Hello everyone, this is Kathy Lien with BKForex. I'd like to thank Pepperstone for giving me the opportunity to speak to all of you today. And March is going to be, or is, a very seems like that's just beginning. Let me start again. Hello everyone, this is Kathy Lien with BKForex. I'd like to thank all of you for joining me this evening in um, Australia, and I'd like to thank Pepperstone for having me. March is certainly a very, very important and busy month in the foreign exchange market. We got a little bit of a taste of that at the start of the month, but the action really heats up today with the European Central Bank monetary policy announcement. We have many, many big events, and we thought it was going to be a good opportunity to talk about some of those events in this webinar. Now, before I begin talking about March Madness, I'd like to share with you this disclaimer that says trading Forex carries a high level of risk and may not be suitable for all investors. So for those of you that are watching this video on demand, I highly encourage you to pause the screen, read through the disclaimer thoroughly before moving forward. Now, March is certainly a very busy month in the markets, and there's going to be, quite a bit of trading opportunities. And you may hear a lot of experts, such as myself or my colleague Boris, talk about where they think the markets are headed in the coming months, and what some of these big events can bring to us. Um, and that's always kind of very interesting. And while it may be very intriguing to hear our views, I think it's important to realize that oftentimes when you watch financial media, it's always about usually the least likely scenario. I guess what I'm trying to say is much people are much more interested in, for example, bringing in a guest who'll talk about the Dow Jones Industrial Average going to 30,000, then expert coming in talking about the Dow Jones Industrial Average going to 21,000 or 22,000, because they want the big targets, they want the big numbers. Basically, outside views are what makes for good television. So the point I want to make is that while it may be interesting to listen to what the talking heads are saying on television, do not focus on their specific price targets, but rather focus on their direction. For example, many people ask on CNBC or on Sky Business, is the euro going to parity? And you may have a bunch of experts coming in, pounding the table saying it's going to parity, when in reality maybe it'll only go to 103. What's really important is not so much the big price targets that they're trying to make sound sexy on television, but rather their direction, because that's really what they firmly believe in. The targets of parity in the euro dollar, or 60 cents in the Australian dollar, is nothing but good television, because most of us know that people watch CNBC with the mute button on, and so they only turn on when that little headline that scrolls on the bottom shows you a very attractive number for you to be intrigued enough to listen to what they say. So I'm not saying that the talking heads on television are not smart. What I'm trying to say is that they're usually there for entertainment, and what you really want to focus on is their reasoning as well as their direction. So we'll let you decide whether the talking heads, including ourselves on TV, are really that smart. But there's one thing that's certain. We do all have years of experience, especially us, in the cold, hard reality of trading. And that's what we really care about, which is there's these great big views I'm going to share with you today on, what could happen in the U.S., what could happen in Europe and other parts of the world. But what we really care about is how we can trade it and how we can benefit from it. Experience, though, is the key to refinement. Boris and I have been through many different market conditions. We thoroughly understand fundamental drivers. We watch multiple markets simultaneously, and we developed and refined trading strategies that we feel confident about, and we trade real money accounts every single day. By the way, I forgot to mention, if you have any questions about anything I talk about, feel free to type away into the chat box or into the question box, and I will get to them at the end of the presentation, because I don't want to distract from what I really want to share with you today. So that experience has helped us hone some trading tips that I would like to share with you. So what we're going to do today is, first, I'm going to share with you some trading tips that gives you an example of how experience matters and how being in tune with the markets matter. Then I'm going to share with you our views in the markets fundamentally. And after that, I'm going to talk about one of our favorite trading strategies that you can use to help trade and analyze the markets, and then we'll take questions. So we're going to start with our BKForex trading tips for those of you that are much more interested in kind of understanding some of the movements, short-term movements in the markets. So experience is the key to refinement. It's the key to knowing what to trade and when to trade. Now, some of you may know that when it comes to what to trade, during the Asian trading session, for example, these are actually my time zones, but in the Asian trading session, which would be your morning, the currencies that move are going to be the Australian dollar, the New Zealand dollar, the Japanese yen, and what you can trade are Australian, New Zealand, and Chinese data. During the European session, which is your afternoon, your afternoon, what you can trade is Eurozone data and UK data. There's a lot of London open opportunities, some of which I'll talk about in a minute, that can also present themselves as potentially attractive trading opportunities. And most of the time in your evening, some of you, I know that our hardcore traders are up late trading the US hours with us, even if they live in Australia or Singapore or other parts of Asia, because they know that that's when the real action heats up, when we have the US-Europe overlap. And at that point, you can trade everything, because the euro's moving, the pound's moving, dollar-yen's moving, and you can trade US data, Fed comments, US stock opportunities, as well as US market opens. But one of the interesting things that I find for the Asian trading session is the price action of the Australian dollar. Now, you may or may not notice this, but when it comes to the Australian dollar, one of the trading tips that has come from our experience in the markets is that the Australian dollar will oftentimes reach high or lows after news. So what that means, actually let me show you the chart and then I'll explain what that means. So basically here we had the most recent Australian employment report, and as you can see, these are 15-minute candles. As you can see from the 15-minute candle in the Aussie dollar, that that this number was probably a good number. So the data came out. We had the Australian dollar pop upwards from 77.20, 77.30. Okay, so not a huge number. But look what happens afterwards. To the right of my arrow, you will notice that Aussie dollar ends up topping out. Shortly after the data is released. Another very recent example is the RBA rate decision. And this is actually a more interesting one because the employment report was kind of mixed, but the RBA rate decision, you can see clearly the RBA rate decision was very Aussie positive. If you remember the last Reserve Bank of Australia rate decision, the RBA came out and they, even though we had some recent pockets of weakness in the Australian economy, what you will notice here is that, or what you may remember, is that the Reserve Bank of Australia kind of dismissed that and remained relatively optimistic. So as a result, Aussie dollar popped. Aussie dollar popped higher from 76.40 all the way to initial, maybe about 35 pip initial reaction, and soared all the way to about 76.75. So, if you're trading this, you may be thinking, wow, this is a really, this is a really big reaction. And, it's obviously a very big green candle. The RBA remains optimistic. They're one of the few central banks that remain optimistic. So you decide to go in. You decide to go in at, let's say you buy the close of that candle at 76.70. And it does rally, but it rallies 10 more pips. That's all you get. And then and then you're sitting in this position, and these are 15-minute candles. So let's say you go in at around, it would be 11 p.m. my time. So you can basically kind of resolve it to what your time is. But let's say you go in, basically 15 minutes after the data, and you're sitting for an hour, 2 hours, and the trade isn't moving. And it's the worst feeling possible because you're sitting there and you're thinking, why is my trade not moving? And you're kind of second guessing your trade. And then, guess what happens? It ends up crashing. And this happens more often than you think. And it happens with Australian data. It happens with New Zealand data, which is that oftentimes the Aussie dollar, the Kiwi dollar will reach highs and lows after news. And what that means is that, the way we trade, Aussie and New Zealand data is oftentimes we fade the Aussie and New Zealand data because we find that the fade opportunity, which may be the harder trade, can oftentimes be the more fruitful opportunity than the chase trade. And part of the reason, we try to find these logical reasons for some of these reactions. And part of the reason for that is because there isn't much participation in Asia. And so sometimes you get the pop, and then what may end up happening is that after you get the pop, then there's no more, everyone feels like the initial move has been priced in, so there's no more participation. And as a result, people start to take profits as they realize that the currency no longer moves in their direction. So another trading tip that I have for you this morning is related to sterling. So I talked about how if you trade the European session, which is your afternoon, oftentimes you will have London open opportunities. So I said oftentimes you may have London open opportunities. So those London open opportunities include breakout opportunities in sterling at the start of the New York trading session. And it's something that I see quite often. So I want to show you what I'm looking at. So basically, in this example here, you will see that cable and whatever move is oftentimes erased in the New York session, but that's, in my opinion, slightly less important. The point that is much more important, in my opinion, is the breakout. So these are all in New York Times. I apologize for that, but my charts are all set on New York Times. So if you see here, you'll see that sterling, very recent chart, just kind of consolidated during the European trading session. It consolidated between 123.50 and 123.85. And at the start of the European session, you did have a little bit of a rally. Sterling rallied about 30 pips. And then New York comes in. And oftentimes, the move starts to happen right before the New York Open around 6:30 in the morning. So New York comes in, and for whatever reason, they feel like sterling no longer deserves to be so strong. And when they take sterling below the range or beyond the range that has been developed during the European trading session, oftentimes that move will have continuation. Here's another example. Here we have consolidation. Now, in this example, we don't have a breakout till a little later on because we have the ranges set pretty much between 3 to 4 a.m. In this case, it's about a 50-60 pip range, so a slightly wider range. So we've got a slightly wider range here, and so we've got a slightly wider range, and you can see that the range is broken around 10:30 New York time, and when it breaks, once again, I mean, there's a little bit of consolidation. This is a 5-minute chart, though, so the consolidation really doesn't keep you anxious for very long. So it's a consolidation, and then finally you get a really nice breakout during the New York trading session. So the last tip that I want to give you before we go into some of the talking about some of the big market views is that the Canadian dollar will often have a delayed reaction or reverse when data is released. And here's an example. This is also a very, very recent example. And it's very similar to the RBA rate decision. Bank of Canada comes out. Clearly from this green candle here, you can see that the move that the BOC was CAD bearish. Dollar CAD rallies, and you're thinking, okay, BOC is CAD bearish. I saw a 35 pip rally in dollar CAD after the BOC, so let me go in. So you go in at 133.40s, and you get maybe a 15 pip continuation, and then it fizzles out. So this shows you that the data is probably more of a fade than a trade. And here's another example. If you remember, Canadian CPI was very, very strong. Dollar CAD crashes. You're thinking, wow, this is a terrible number. Dollar CAD's crashing. Let me get in and sell dollar CAD. And look what happens. It bottoms out and actually it's reversing and erasing all of its losses. So let me ask you, what is the better trade in these examples? Let's go with the data trade or the fade trade. And as you can see, the fade trade is much more powerful. Now, this may not be the case for US data. US data and Eurozone data and UK data oftentimes has more continuation. But Australian data, New Zealand data, Canadian data oftentimes has more of a characteristic to reverse. So these are the tips that we bring to you from our years of experience. And these are tips that we use to trade every single day at BKForex. So in general, we believe that when it comes to trading, there are 3 ingredients for a perfect trade. And those 3 ingredients are fundamentals, technicals, and sentiment. We talked a lot about kind of really micro price action, but we're going to steer away from micro price action right now, and we're going to go into bigger moves, bigger price action. And the way we start is with the fundamentals. We start with a top-down approach to the markets. We start with the big story. And the big story, is the major themes that are happening in the markets. And quite honestly, there's a lot of major themes that are happening in the month of March. Today, we have the European Central Bank Monetary Policy meeting. Tomorrow, we have non-farm payrolls. And then some of the big events that we have next week include the Federal Reserve meeting. the Dutch elections, the U.S. debt ceiling being hit, the G20 finance ministers meeting, and sometime before the end of the March, the UK plans to trigger Article 50 for Brexit, which could happen next week. And we could also have Scotland announce a second referendum. Now, this is just kind of the big events that plucked out. Next week, we also have U.S. retail sales. We also have Australian employment. We also have the Bank of Japan and the Bank of England rate decision. So we have a lot of other things going on as well. But these are some of the quote unquote higher profile events that are going to set the stage for March trading. So let's start with the March ECB meeting, which is happening in just just an hour and under 2 hours. Now the ECB meeting is kind of twofold. First, you have the ECB meeting, and then you have Mario Draghi speaking. So the ECB makes its announcement at 7:45, and then you have Draghi speaking at 8:30. So there's two opportunities for volatility. And talking about the ECB meeting, I want to share with you this table that I put together. Well, that's kind of small. I'm just gonna, and I posted this on my Twitter feed. If you ever want to follow me on Twitter, my handle is Kathy Lien FX. But I put together this table, which illustrates how the Eurozone economy performed since the last monetary policy meeting. The last time that the ECB met was actually in January, so it's a bit longer of a gap than usual. So the ECB met in January, and the economy has evolved, in my opinion, quite a bit since then. So if you take a look at this table, you'll notice at first glance there's a lot more greens and reds. So there's a lot more improvements. For example, German retail sales fell less. Eurozone retail sales fell less. Labor market activity is really good in the sense that the unemployment rate declines. And we also have inflation, which is a really big deal. Inflation is up significantly. I mean, just look at the German CPI numbers. Went from 1.7 to 2.2. The Eurozone CPI went from 1.1 to 1.8. These are the strongest numbers in 3 years. Manufacturing activity is up in both the Eurozone and Germany. But of course, there's areas of weakness, like the German IFO survey is weaker. The ZEW survey is kind of mixed, consumer confidence kind of down, and more recent indicators in the form of the German trade balance as well as industrial production have been weak. So how do we take this into context? Well, the way we take this into context is that this is a quarterly meeting, and this quarterly meeting is significant in the sense that the ECB is going to deliver its latest economic staff forecast. So from the table that I showed you, you can see that the ECB is probably going to raise, it has to raise its inflation forecast, and is probably going to raise its economic forecast as well, because there has been enough improvements in certain areas to support an upgraded economic forecast. So, I believe that the euro is probably going to pop when we get those upgraded economic forecasts, but the ECB is not ready to raise interest rates. And Mario Draghi has made it known that he wants to look past the temporary effects of higher inflation. So ECB policy is on hold probably throughout the third quarter. While Draghi will be encouraged by the recent PMIs, he doesn't believe that that inflation as well as the recovery is durable, because industrial production as well as the trade balance figures have been softer, indicating that the weakness of the euro is starting to have a fading effect on is starting to have a fading effect on growth. And he's going to be disappointed by the lack of structural reforms in Eurozone economies. So I think he's going to sound more cautious, and he's going to try to talk down the euro, and he's going to try to downplay any upgrades to the economic forecast. And the reason for that is because he's going to be because the weaker euro benefits the Eurozone economy, and they're going to hold on to that for as long as possible. Tomorrow we have the March non-farm payrolls. We're actually live trading the March non-farm payrolls, and I'll put up a link after our webinar for you to sign up for the live trading March non-farm payrolls report. But this is obviously a big one because it will play an essential role in determining whether or not the Federal Reserve will raise interest rates. Now, it's not really going to boost rate hike expectations by much, and the reason for that is because March rate hike expectations are already at 100%, and so the question is, how much more can it really rise? Well, where it really makes a difference is not so much the March rate hike, but rather the June rate hike expectations. And in general, confidence is up. The ADP report was very strong. Jobless claims have been very low. So conditions are certainly ripe for investors for non-farm payrolls to surprise to the upside. So dollar yen is up today, and I think it's going to continue to remain strong going into tomorrow's non-farm payrolls report. And actually, it may break 115 on the back. It really needs non-farm payrolls to break 115 in dollar yen, but it can challenge it, and I believe it's going to break it on the March non-farm payrolls report. Of course, all of this leads up to the March FOMC meeting, and so the deal with the March FOMC meeting is, first of all, it's a quarterly meeting where the FOMC, the Federal Reserve, is going to deliver its announcement, and then Janet Yellen is going to have a press conference. And the reason why a lot of people kind of circled around the March date is because this is the first rate hike we've had in a while, and they believe that Yellen is going to want to take the opportunity to explain the decision. But as traders, what we fear is that we've already had a huge run-up in the dollar going into FOMC. Expectations for a March hike is already at 100%. So could this be the classic buy the rumor, sell the news type of price action? Meaning Yellen hikes, Yellen's hawkish, could we see profit taking in the dollar? We've seen it before, and with expectations so lofty, could we see it again? And it's possible, but let's take this into consideration. First of all, every single Federal Reserve official has said that interest rates will need to increase. And Yellen, as well as many other Federal Reserve officials, along with data, have suggested that we could get 3 rate hikes this year. So after this one, we could get 2 more rate hikes beyond that. So the guidance is key. If Yellen remains transfixed and suggests that we could have 2 rate hikes and maybe even 2 more rate hikes and maybe even 4, or we got to prepare. She indicates that we got to prepare for additional tightening. then it could very much be the case where we have an additional run up in the dollar. But I would be very careful. We're also live trading FOMC because it's such a precarious event, and that it's not just the rate decision itself. It's also very much her guidance. I would be long dollars going into FOMC. I'd be cautious of being long dollars after it because it could be profit taking. But if we get the pop post FOMC, that's where I'll be taking profits, waiting for a dip to get back into the position. The Dutch elections. With the Dutch elections, that's also happening on FOMC day. The Dutch elections are important. And the reason why they are important is because it could set the stage for Europe's far right. Hold on a second. For Europe's far right. As you may know, the anti-immigrant, anti-EU parties have grown. And the question is, will the upcoming elections in the Netherlands as well as France reject this overall sentiment? And that's really the big question. The Dutch elections are viewed as Europe's bellwether for a reason, because the results could predict how successful the right-wing populist parties will be in other European elections, namely the French elections. And because the Freedom Party's Wilders has been known for his rapidly anti-Muslim, anti-immigration policies. And if he becomes the new leader over the incumbent, who's more of a liberal, is more optimistic, then that could, first of all, lead to significant sell-off in the euro, because it could lead to the market thinking that Marine Le Pen has a greater chance of becoming the president of France. So what happens in Netherlands could influence elections in other parts of Europe, because after the Netherlands, France will take to the polls on April 23rd for the first round of voting. And that will tell us how far ahead or how far behind Marine Le Pen is to her counterparts. So, I think this is quite important. And the reason why I think this is quite important is because I believe that, because I think everyone believes that the Netherlands elections will play a very big role in how the euro trades next week, as well as how the euro trades going into the French elections. The U.S. debt ceiling, 2 days later, March 17, the U.S. debt ceiling will be reached. Not many people are talking about this because they're expecting it to be increased. I mean, in the past, the raising the debt ceiling has been used by Congress to get concessions from the president. This administration has very different views. It's because the Treasury Secretary appreciates that making timely debt payments is critical. And the head of the Office of Management and Budget and the president himself have talked about renegotiating the debt and prioritizing payments. And with the Republican Congress and the Republican president, I think that the March 17 debt ceiling will pass without any major fanfare, and I think they're going to raise the debt ceiling as expected, and it's probably not going to be as disastrous as everyone anticipates. But it's still an event risk worth watching on the calendar. The March 17-18 G20 meeting, G20 finance ministers and central bankers will meet on March 17 and 18. It will be the first one attended by the new U.S. Treasury Secretary, and he's going to get a lot of attention. And he's going to probably talk about exchange rates. He obviously thinks that the euro is undervalued, thinks lots of currencies are undervalued. He wants to see them stronger. He obviously thinks that a lot of central bankers are artificially weakening the value of their currencies, and he's going to want to prevent that. And so I think it's a pretty big deal. and I think it's something that he's very much going to be focused on, and that's that could be a pretty important event risk for currencies because currencies will be on the topic of the G20 meeting. And then, of course, Brexit. A month ago, it looked as if the UK Prime Minister would trigger Article 50 this week, but the time frame is unlikely now that the House of Lords passed an amendment to the bill, which seek to protect the rights of EU citizens in the UK. It is more procedural than substance, and some government officials were sympathetic with the sentiment. And so I think it's just going to delay the triggering of Brexit to next week. And that's going to be very important because sterling's very weak, and I think that it will remain weak. It could weaken further on this possible triggering of Brexit. So when they announced the trigger of Article 50 or leading up to it, and leading up to it, we should see sterling fall. But after they trigger it, it could also be the classic sell the rumor, buy the news. Investors may be relieved that's already happened, and the path has begun, and the resolution to the uncertainty has begun, and they could actually end up buying pounds after the trigger as a result. But of course, that may not be until after we have a big crash in the pound dollar first. So that's basically my big picture outlook. I'm sure many of you are keen to ask about the Australian dollar. Aussies being pulled down by the US dollar. I think since we're looking for the Federal Reserve to be raising interest rates next week and we're looking for further US dollar strength, I think we could see further Australian dollar weakness. We had a major breakdown in the Aussie. I think there could be continuation. Australian economy obviously isn't doing as bad as other countries, but the currency has been strong. It's the best performing currency this year, and I think that's going to come back and bite the economy, particularly in light of weaker growth. So now let's spend some time talking about a trading strategy that I wanted to share with you. Many of us, as we watch some of the moves in the markets, think about when these moves will end. For example, we watch the US stock market skyrocket and we think it's got to top out. It's got to stop. We think about the slide in the sterling and we think about when will it bottom out. We look at the rally in dollar CAD and we think about when could it top out. And this kind of talks to the popularity of picking tops and bottoms in the markets and why we as humans and individuals generally like to think as contrarians, because we like to think we're smarter than everyone else. We like to think that whatever's happening cannot go on forever unchanged. And that is why there's so many technical indicators built around mean reversion, built around identifying and picking tops and bottoms, such as RSI, stochastics, Bollinger Bands. All of those are designed to basically help us, or designed to identify tops and bottoms in the financial markets. In fact, even hedge funds do it. Hedge funds are known for their strategies of mean reversion. They're known for basically looking for outsized moves and trying to basically figure out when these quote-unquote assets are going to get back to the norm. And, I have to admit, it works very well for the shares markets. The reason for that is because the reason why it works so well for the shares markets is because, generally speaking, shares have valuations. And, assets are either overvalued or they're undervalued. And they can be over and undervalued for long stretches of time. Sorry, they can be overvalued or undervalued, and they generally aren't necessarily overly over or undervalued for super long stretches of time. They're just, they have PE ratios and things like that. So it works well for shares, but doesn't work well for indices, currencies, and commodities. And the reason for that is because these tend to be trending instruments. They tend to be trending instruments because there isn't any, clear valuations. A lot of times these instruments move on sentiment and expectations. So what can you use to help you? What can you use to help you pick tops or bottoms? Let me introduce you to one of my favorite indicators, which are the Bollinger Bands. But I don't necessarily use them in the traditional way that you use Bollinger Bands. The traditional way of using Bollinger Bands is to use them as overbought, oversold signals. For example, in the Eurodollar, if you were using Bollinger Bands in their most traditional way, what you would do is if Eurodollar fell to the Bollinger Band, you would buy, let me see if I can get my little arrow working here. You would buy here, buy here, buy here, buy here, buy here, buy here, buy here. You would have made money if you sold this, but although you probably would have been stopped out. Depending upon where your stop is, maybe you would have made money when you sold that, but you certainly would have lost money at all these phases. So is there a better way to do this? Yes. And the better way to, and the reason for this is because, currencies are trending, and even pulling up any chart like dollar CAD, for example, right now, you will notice that when we get a good trend going in the markets, the trend can last for some time. And so picking tops and bottoms using the Bollinger Bands may not be the most fruitful way to do it. So what's a better way? What is our way of using Bollinger Bands? Well, in addition to standard Bollinger Band, which is the 20 period 2 standard deviation, what we've done is we've added in the 20 period 1 standard deviation Bollinger Band. So we've added in the 20 period 1 standard deviation Bollinger Band to create these double Bollinger Bands. So as a rule of thumb, I like to say, so basically the outside lines are your 2 standard deviation Bollinger Bands. The inside lines are your 1 standard deviation Bollinger Bands. So these are the outside lines, and this is the inside line. So how can you use the Bollinger Bands? Well, you can use the Bollinger Bands first to determine whether we're in a trend or range environment. And I think this is really important because it can help us characterize what the market, what is happening in the market right now. So as a rule of thumb, when the currency is in the 1-2 band of upside, in this area here, I like to say that it's in trend. If it's trading between the first standard deviation Bollinger Bands, I like to say that it's in range. And obviously, if it's trading in the 1-2 band in the upside, it's in the uptrend. If it's trading in the 1-2 band in the downside, it's in a downtrend. So how can we turn this information into a trading strategy? Well, you can use the double Bollinger Bands to help you pick tops and bottoms. And the way you do that, and what I want you to notice on this chart is that rather than, like on my left-hand side of my chart, let me get my arrow again. Rather than sell here, sell here, sell here, you want to wait for the currency pair to roll over, fall below the first standard deviation Bollinger Band, and that's when you want to sell. Same thing here. You want it to roll over, fall below the first standard deviation Bollinger Band, and that's when you want to sell. And what you'll notice is that oftentimes it likes to touch the Bollinger Band on the other side. So let's wrap some rules around it. The first step is that you want to look for a close above or below the first standard deviation Bollinger Band. So you want to look for it to go in trend. So you want, in this example here, you want to look for it to close below the first standard deviation Bollinger Band. And then you wait. You wait for it to close back above the first standard deviation Bollinger Band. And then you take the trade. So this actually says should go long the next candle. Because what you're doing is you're waiting for it to drop below the first standard deviation Bollinger Band, waiting for it to roll. So it drops below, waiting for it to roll back above, close above the first standard deviation Bollinger Band, and that's when you pick the bottom. Your stop is 30 pips back below the first standard deviation Bollinger Band. So 30 pips back below the inner line, back below the first standard deviation Bollinger Band. So because it was a close at 101.10, 30 pips below the first standard deviation Bollinger Band, which is not just 30 pips, 30 pips below the first standard deviation Bollinger Band, is in this case at 151. And then you target 1 times risk, you move your stop to break even, and then you trail your stop on the remainder of the position. So when it moves by, in this case, 60 pips, you take your first half of the position off, and then you move your stop to break even, and then you can trail maybe by 50 pips or something like that. Here's another example where basically you see that the currency pair is falling, 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 falling. Do not pick a bottom because the trend is strong. You wait for it to close above the first standard deviation Bollinger Band. You buy, target, your stop is 30 pips below the first standard deviation Bollinger Band. You target 1 times risk, and then you trail your stop. So that is trading the Bollinger Bands using daily charts. I'd like to show you a shorter example, although not ultra short, using 4-hour charts. So basically, you're still using 2 sets of Bollinger Bands, 20 period 2 standard deviation, 20 period 1 standard deviation. But in this case, for a long trade, what you want to do is you want to look for 2 candles to close beyond the first standard deviation Bollinger Band. So basically, in this example here, you're looking for at least 2 candles in the upper area. So you're looking for at least 2 candles in the upper area. And then, because we're picking a turn, you check to see if the past 2 candles has moved beyond the Bollinger Band by 10 pips. The rules are kind of off. I gotta fix them because they're for a different example. But basically what you want to do is you want to look for 2 candles to close above the first standard deviation Bollinger Band in the uptrend. Then you want to look for 2 candles to close below the inner line by at least 10 pips. After that, you go short, and you go short with a 50 pip target, 60 pip stop. And it's slightly negative risk reward, but you only need 55% accuracy to break even on the trade. And we get that. We get about 70% accuracy. Of course, past performance not indicative of future results. So here, you short here. So basically, you wait for it to go into the buy zone, and then you look for 2 candles to fall below it. You short, and then you take a 50 pip target. And here's another example. Here you see we're in a very pronounced downtrend. We wait for it to close above the first standard deviation Bollinger Band by 2 candles. And we make sure the last 2 candles were below the first standard deviation Bollinger Band, and then you buy. So here, this is not a valid trade because here, this close was below the Bollinger Band. But here, when you finally get a positive signal, you have one close below, one close above. And so it's not, and this is not, by this time, it's not a valid trade. And the long rules are basically the complete opposite of the short rules. So that's basically an example of how you can use the Bollinger Bands on daily charts as well as 4-hour charts. And that's how entries and exits are determined. We combine a big macro picture view with our technicals, and we use that information to help us identify entries and exits. And we always believe that entry and exits are equally important, because the example that I like to give is, imagine you're on an airplane. Would you rather your pilot get the takeoff right or the landing right? And I'm sure every single one of you prays that your pilot gets the takeoff and the landing right, because any part of that goes wrong and you're in trouble. So if there's one thing that you take away from what I am sharing with you today, I hope that it is you want fundamentals, technicals, and sentiment to be on your side for every single trade. So what we do when we see those Bollinger Bands turns is that we basically look to make sure that fundamentals support our thesis, and that's when we take our trade. So with that, I'd like to open up the floor to any questions that you may have. And as I said, we are live trading on the U.S. non-farm payrolls report tomorrow. So if you just go to Kathy Lien FX, the invitation link is, I already posted the invitation link, although I'm not too sure why it's not showing up here. But I'll tweet it again later. For some reason it's not. Let me refresh this. And I'd like to, with that, open up the floor to any questions that you may have.
Hi, Kathy. Got a really good question here. What's the best way to measure or find the market sentiment within the trading platform?
So that's a very good question. It's kind of difficult to gauge market sentiment, but I think the best way to do it is to watch the equity and bar markets. Also, you can get a sense of you want sentiment on your side in the sense that you want ideally to be buying dollars when the dollar is rising, and you want to be selling dollars when it's falling. You can also watch the stock market. If stocks are doing really well, the market's optimistic, and if they're doing poorly, chances are you may have risk aversion.
Thanks, Kathy. Got another one here. What would you say, aside from the double Bollinger Bands, are the best technical indicators to trade these types of events?
Well, oftentimes, like for example, when we trade NFPs tomorrow, we trade price. And I'm just trying to open up. It's basically, I chatted everyone the link. It's just bit.ly March NFPs, and it's completely free, but and open to everyone. But basically, we trade price, and so you'll see that we use sometimes we like to use other indicators, but we primarily focus on price.
Great. And here's another one around the non-farm payrolls. Aside from the US dollar, what currencies do you think would be the best to trade around this event?
Well, when it comes to non-farm payrolls, the currency that will be react the most is going to be the euro dollar and dollar yen. But you could also look at the yen crosses. They'll probably be moving quite a bit as well. If you want to learn how to trade non-farm payrolls, as I said, we're doing it live tomorrow. You can see us do it live in live market environments.
Fantastic. Got many people excited for that. Here's another one, probably a trickier one. With the Brexit and the European elections coming up, do you think that if the crazier parties like Marine Le Pen and Geert Wilders actually get in power, do you think that could be very big trouble for the euro?
Oh, yeah, absolutely. And that's why the Dutch elections are such a big focus, because if the Dutch elections show that the far right, basically far right wins, it's going to boost expectations of of Marine Le Pen winning, which is going to be negative for the euro. So that's why the Dutch elections itself could trigger a big reaction in the euro because of the fear of what it means for the other elections, the French elections.
Great. Thanks, Kathy. Here's another one around your double Bollinger Bands. What would you say are the best timeframes to trade for that particular indicator? And also, does it work on all of the currencies?
We use it on all the currencies, and I like to use it on daily charts and 4-hour charts.
Thank you very much. Here's one last one. So in terms of the stock market, would you say that's a really big indicator for the currencies markets as well? Like, is there a big correlation between the two?
Yes, I think so. I think the stock market is a good indicator for the currency markets, and I think that its relationship has broken down a little bit lately, but in general, though, I do feel that it's a pretty good indicator.
Thanks, Kathy. I think that's the end of the question.
Okay, great. So I hope you all enjoyed the session, and I thank Pepperstone for inviting me, and I look forward to speaking to you again.
Great. Thanks, Kathy.